Hey guys, welcome back to CandleLight, Montana here. I'm doing a bit of a different format. I wasn't really pleased with last video. It was kind of slow and flat, and I'm hoping to improve my editing skills. I'm not a computer guy, hence why I love using TradeStation. It's pretty simple to use, but I'm slowly getting my editing on point. So I'm hoping that this video is a bit more interesting to watch and a bit more dynamic. Now, last episode I went over essentially how to read candlesticks. You know, the candlestick basics, the components or the inputs. Every candlestick has an open, close, high, and low, and how you get the wicks and what are they. And red candles generally mean price is going down, which is bearish because a bear swats from up to down, and green candles, which essentially is a bullish market or any kind of rally. The way I differentiate that is I normally just think about the bull, either a bull's horns going up, or I just think about that big copper or brass or whatever metal they use for that big bull on Wall Street, because Wall Street and everyone wants price to go, or the value of stocks and everything to go up. So I just know that anything bullish or the animal, the bull, represents price rallying, and then the opposite of that is bear, so it must be going down. So in order for you to understand how to read price action, particularly as a beginner, which will ultimately help you understand what technical analysis is, and particularly also for beginners, is knowing what a candlestick actually is. Now, we went over, greed and fear, which is bullish and bearish in episode 1 or in the past video. But the second aspect to that, or the second facet to what a candlestick is a differentiation on a huge misconception of what a candlestick actually represents. A lot of people think that candles represent volume. Now, there's also a huge trading methodology and a lot of schools of trading that use volume as a primary reason, or as a leading indicator, so to speak, on whether or not to enter a trade. Now, I'm sure they use different, other facets or other indicators or other reasons to go into a trade. But for the purposes of this video, I just want to cover why candlesticks do not represent volume. Candlesticks, if I were to put you into an auction, right, where the opening price of a beautiful 1967 Mustang is being offered for like $20,000, and there's let's just say thousands of people there, and each person bidding for this auction or bidding for this car at $100 increments. Well, after a while, it goes from 20,000 to, let's just say, 30,000 or whatever at $100 increments. That's a lot of volume being put in. But one guy with a lot of buying pressure, with a lot of demand, a lot of greed, offers $100,000. If you were to have that rate of growth, or essentially rate of growth on a chart, it'd be pretty steadily moving up, and then all of a sudden you see a big green candle trying to cover the distance in dollars from, it opened from 20, and then all the bids got you to 30, and when he came into the market, it went from 30 to 100 grand. That's going to be a really large green candle. Now, you had a whole bunch of volume happening from $20,000 to $30,000, but just one guy with a lot of demand or buying pressure, not volume, made price go all the way up to 100 grand. That's why candles don't represent volume. They represent speed of price. Now, before I go into speed, just let me show you what that looks like on a chart. Here you see a large red candle, right? If all things are equal, because they must be in trading, a large red candle or a large candle period must have an equal amount of large volume. It doesn't. There's no correlation between that small amount of volume and that large candle if you believe that candlesticks represent speed, or that candlesticks represent volume. Another example here is you have a huge spike in volume right here, but the size of the candlestick is pretty much, on average, the same size as these 5, 6, or 7 before it. That isn't making any sense. To drive this home, you have no volume on these two candles, so you'd expect them to be minuscule. You hardly would even be able to see them, yet they are almost the same size as these two before these two that have two huge spikes in volume. If you're trading on volume being your main reason of going in and out of a trade, you're getting hosed, because there's essentially no rules. These two huge candles should have massive volume spikes. They don't. They're very much average to all the ones before and after. Again, not giving you a good indication on whether or not to buy or sell. This one has hardly any volume whatsoever, yet it is pretty much on average, kind of actually a bit bigger than the ones before and about the same size as these about the same size as these two, but again, not making any sense. No volume like this, the candle should be minuscule. This candle is very much average to the 3 or 4 before it, and to the 2 or 3 or at least the 2 after it, yet there's a huge volume spike. So if you're using volume as a reason to go into a trade, and solely volume for a reason, and solely volume being a reason why you'd go into a trade, definitely not the tactic you want to be using. And more importantly, that's not what candlesticks actually represent. So if you were to look at, well, really anything that has an XY chart, but let's actually, bring this into something that we're talking about. An XY chart is essentially what price is. The Y vertices is distance, and the X vertice is time. If you see any kind of line in between, we've all done high school, we've all taken algebra, that is rate of change. That's acceleration or deceleration, whether that line is going up or down. And anytime you have an oscillating amount of acceleration and deceleration, that's calculus. Now, I definitely cannot do calculus, and I can barely do algebra, but that's what price is. You have an XY chart with a fluctuating amount of speed or lack thereof. And because price is fractal, and that goes into time frames, which we're going to be covering later. But because price is fractal and all things are equal, the same thing can be said of candlesticks. Let's go over this. Candlesticks represent velocity equals distance over time, okay? Like, they represent speed of price for this reason. If price opens right here and rallies all the way up here, let's just say from $20 to $30, it covered that amount of distance in dollars. So from $20 to $30, that's $10. Covered that much distance. This one, because we watched last episode and we know that what the wicks represent, it means price opened at this point, it fell, covering this distance, rallied all the way back up and closed up here. Now they're pretty much, they cover the same distance from the open to close as this one, but this candle, the hammer, went all the way down and then rallied all the way back up, covering this distance to the downside and this distance to the upside. What does that give you when you add up all the distance that the first one took and then compared to the second one had to cover? It covered almost twice the amount of distance in the same amount of time. That's why candlesticks represent speed of price, velocity. And what's so great is, just like what the markets are it's a living organism. Everything has to tie in with everything else, which is why if you use a reason to go or to trade, or you use a reason to go into any kind of position, the system you use, everything must be equal. And that's what's so great about supply and demand, because economics 101 is more demand than supply, price goes up, more supply and demand, price goes down. Now, that ties in beautifully with candlesticks representing speed. Why? Just like the auction, that guy that really wanted that Mustang, he put a lot of demand in, not volume, but he put a lot of buying pressure, a lot of demand. He was willing to pay $100,000. No volume whatsoever, but a lot of demand, making price rally quickly from 30,000, I think I said 30,000 to $100,000. That would be a big green candle. Now, I'm about to show you some examples of that tie into supply and demand. I'm going to go into supply and demand in the future, but in order for you to know exactly, what you're doing as we continue our learning, just take my word for it. These are supply and demand zones, and we'll cover those in the future. But look at the effect of what supply and demand has in the markets, and how speed of price makes a lot more sense than candlesticks representing volume. Right here, this is a demand zone. This is called a rally-based rally. It's almost a poster representation of what it's supposed to look like. When price falls into an area of overwhelming demand, when there's a lot more demand than supply, price will rally out of that area ballistically. Large green candles are called, or large candles, relative to the other ones, either before or after, are called ERCs, expanded range candles. They're large. Much like the auction, if there's a lot of demand, price will move quickly out of that area. That's why candles represent speed of price, because there's a lot of demand here making price move quickly. Let's look at what that looks like. Let's see what that looks like to the downside. This is a supply zone. The origin of strong move to the downside, so that's overwhelming supply. When price enters an area of overwhelming supply, it moves quickly out of that area. Quickly, in other words, speed of price. You see big red candles, to the downside. Let's move over here for the last two examples. Here's an area of demand. This is called a drop-based rally. the two times when price enters, right here and right here, when price enters this demand zone, price moved quickly out of there. Why? Because they covered a lot of distance in the same unit of time. Every candle represents 1 day. When price re-enters that area of demand, it moved quickly out of there and gave you that huge rally. It moved quickly because there's a lot of demand. Last example, origin of a strong move to the downside, right here, that's supply. When price enters an area of supply, it moves quickly out of that area because anytime there's overwhelming supply, there's always going to be a large move away from that area. Economics 101. So whenever you trade, you need to have a system, and I highly recommend you use simple, time-tested supply and demand. Economics 101. That's what moves price. That's what candlesticks are telling you. It's not volume. It's an overwhelming amount of supply and demand in areas that we will learn to identify. So for future reference, anytime you look at a chart, candlesticks do not represent volume. They represent speed. Volume has everything to do with transactions, which we'll be covering soon. But for now, whenever you look at a chart, you now know what a candlestick is, the inputs, the open, close, high and low, and all that. And they're telling you speed of price. Look forward to seeing you guys on the next one.